Chris Hallows here with the 2023 rate and housing forecast. And, a lot is changing in the real estate industry. Recording this at the end of January 2023. And a lot of people having the question of when should I buy, when should I sell? And it's great questions. What's happened behind us here is not necessarily unprecedented, but how fast it happened is. And so it's leaving a lot of people wondering what the future holds for them. I hope what I can do is layer a bunch of data here. I'll do it as quickly as I can, but I want to give you as much detail as I can on what I think you'd need to know. If you were my friend and you were considering buying a house or selling a house, what you might want to take a look at so that you can find a better opportunity than not. And I did give some credit up here. I got Barry Habib. He's a decade-long industry commentator. He's been on major news channels. He's been given the Forecaster of the Year award by Zillow and Pulse Economics several years in a row. And so while no one knows the future, hopefully with this layered data and some dots connecting that Barry's put together for us, you can make your own plan and build your own opinion on what's going to work out best for you when it comes to your housing needs. So call me, call your local realtor expert once you form your opinion, but let's dive into this. So looking at inflation, right? That's the number one driver right now of what's impacted our economy. Of course, many factors going into inflation, but as we can see, once you see that little red line, and once the market's determined it's not transitory, it's not going away, rates went hand in hand with inflation. As inflation started to curve down, so have interest rates. But let's talk about that a little bit more specifically. As we watch the Fed has been moving the funds rate, all this action has happened to curb inflation, but it's still here and it's still having an impact. And how does that change markets? And it's really because of a lag and how that works with then year over year reporting. And so, way back in the summertime, Barry Habib, who I mentioned, he said, mark November on your calendars because that's when October CPI is going to come out. And if you look at October 2021 compared to October 2022, we can see a big reduction. And sure enough, October was the highest interest rates, like you can see the highest inflation number, the highest interest rates that we've seen in the last 30 years, hitting in the 7.5%. And then all of a sudden, once the November reading, that report on October came out, we saw a big shift, and all of a sudden rates now have dipped down into the sixes, right? And so what's the next number? What's the next big pin on the calendar is May 10th, because what's going to happen, you can see that these subsequent numbers of January, February, March, these aren't quite as high. February and March are not quite as high as some of the numbers behind it, right? And March is quite a low number. So we could see a pretty stagnant CPI reading and not really any head movers to really show us that inflation is going down until the April number, which will get reported in May. And so that's where Barry's thinking about we could see rates dip down considerably again. Some forecasting in the fives, right? Getting back in the fives range, which will feel again a heck of a lot better than the sevens. It's just a lag. One of the biggest things in the lag is the shelter costs, right? 39% of the CPI is in shelter. And so we all know it, that real estate market slowed down, and that's exactly what the Fed wanted it to do. So while we are feeling it on the front end here, we got January right behind us here, and we can see that CPI is just lagging, right? It's the back half of the roller coaster that we're going to have to wait for here. So, and one other piece that gets a little technical that I wanted to bring up to you, though, is just because of the volatility in the mortgage market. We know, and it's important to know that mortgages are security, right? You're paying your mortgage every month. An IRA, hedge fund, other retirement plan or account is making that interest. And there hasn't been with the servicing and the secondary market, and all these different aspects that go into the securitization of a mortgage, with all the volatility in the market, what's happened is that not only have rates, you've seen it if you called me within the last 6 months, not only have rates gotten a lot higher, the costs have gotten higher. And what typically is then, as we compare to other securities like the 10-year Treasury, usually mortgage rates are only about 1.75 to 2%, so 175 to 200 basis points higher than the Treasury. And it was 300 just behind us here. So that gap has gone so considerably higher, where if we say, okay, that gap is going to normalize, hopefully, and you can see that when we've hit levels of the Treasury, you can see in these lower red circles, that with that normal spread, that puts those rates in that 5% range. And so that's where experts are kind of coming up with that and saying, compared to other market normals and indices, once things calm down in this mortgage industry, that we should then see those rates come down. So there's more fuel for that. Recession, that's a big comment there. We know certain signs of high credit card debt, low personal savings. Those are realities right now. But another big, and I'll let you Google this there, but the inverted yield curve, what does this all mean? But basically, every time this chart hits, you can see every time this yield curve goes inverted. So basically goes, the 10-year goes below or negative, that we have a recession. And so right now we have seen, you can see this on the right-hand side there, we have a big inverted yield curve. What's going to happen? A likely recession. But what does that mean then for housing with those things that we just explained? Well, interest rates typically improve during recessions, right? And why is that? Because we need to spur up their economy. And so what we then see in the last 8 of the last 9 recessions, housing improved value-wise because of a lower interest rate environment. The only one exception to that is the bubble burst and the financial crisis that happened in that tied to mortgages, right? And so why do we think values will continue to improve in this next recession? It's because of demand. We've talked about this before if you've been queued in with us at all, but basically 33 years old is the median homebuyer age. And if we look at birth rates generationally, and to predict household formations, right, is to say, okay, in 2006 in the bubble burst, we were in the middle of Generation X, right? Some of the lower birth rates, if you look from the mid-1990s up to now, right? We have the millennial wave is this massive population wave that we're just hitting the top of the wave. And that back of the wave is very, very heavy, right? And so we just know that there are a lot of household formations coming to the market needing housing, whether people are graduating college, getting married, hitting that time of life. And what we look at here is that if we compare household formations to completions here, that you can see it even up to now, 2022, formations are outpacing completions. And there you go. There's a bubble in 2006 when you have way more completions than you have formations. There's just a big dip in the demand. As we then look at, and actually, I'm going to pause there real quick and bring up this chart. This is local current market stats for Flagstaff, and we look at that in the absorption rate, right? Because where's the inventory in Flagstaff? When we look at, we were hovering around. So this is in 86001. I think I pulled it. Let me check. Yep, 86001. So we were hovering around 2.1 months of inventory. As far as the realtor measure of a balanced market between buyer and seller, we need about 4 to 6 months of inventory on market. Haven't had that. Started in the summer to get up to about 3.24, but even at rates at their peak, we've seen months on inventory just go down, right? And so what's also very interesting is looking at list to sold ratios, is that even right now we're seeing 93%. So certainly people are maybe listing more competitive. The crazy euphoric market hopefully is a little bit behind us in some ways, but that people are only reducing prices up to about 7% from list is what the average is right now. So pretty interesting things right there. And so when we then look at home prices, they're up 115% in the last 10 years, 39% in the last 2 years, and so far only down about 2.5%. Right? We have, the hard part is you're dealing with the mainstream media, right? They love their clicks. They don't necessarily love to tell you the truth all the time. Won't get too past that. But what we can see is certain, a major real estate reporter from one of the major networks has been saying this type of commentary. So pause this slide, read all this. And if you would have bought a house in October 2015, you'd be a lot happier than buying today, right? And so it's just a matter of saying you've never been shot straight. There's always this fear out there in the market, and you can see when other people were saying run, 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 you can see you would have gained 5, 6, 4% per year, right? And look at what that would do to your equity position. Pretty significant, right? And so basically, to wrap this here, and I apologize, going on just over about 10 minutes here, we anticipate lower inflation, a recession-like slowdown. Incomes should be positive, though, so some help there on affordability, although very tight inventory and rent's still expensive and rising. So what's that? Yeah, low digit appreciation likely. So actually, values holding up and maybe slightly going up in single digits. As far as rates, we have some headwinds, right? Global quantitative tightening, lack of foreign central bank buying, more debt to be financed, and then tailwinds, like we talked about, lower inflation, better, calming mortgage industry, and mortgage value on the back end of that, and then the likelihood of a recession. So ultimately, we have predicting that basically about second quarter, the rates move into about the fives, is kind of what we're predicting there. So basically, this could be, I don't want to sound too bold on it, but this could be a very opportune time. Well, the rates are still high in this first quarter of the year. Probably have to record this again in the second quarter to see what's happening then, to take advantage of seller negotiations and be maybe one of the only couple people going to that house right now. Whereas once we go from the high rates now into the fives, and that sheer demand of people, especially here in Flagstaff, you're competing with so many different people, right? The Valley, people moving in and just discovering this town. I'm worried that we'll have a very busy summer. And so, yeah, please connect with me. Let's make your plan. Let's get your strategy together. And if you have any questions about this data or any other input, we'd love to hear from you. All right, take care.